once we've taken all these hurdles, I think we can be more optimistic about German growth and also about European growth. Because today was a historic day. Remember that Germany had used a stricter fiscal rule than the European fiscal rules, and Germany had always been the beacon of fiscal stability, and this has now completely changed, complete U-turn, and especially with these investments in infrastructure, we should see the German economy clearly kind of staging a cyclical rebound second half of this year and even more next year. The big question is, will we also get, again, higher or improved competitiveness? And this is up to the coalition, to the incoming government coalition, to add more structural reforms to this whole package.
Yes, I'm glad you mentioned the competition issue. And Carsten, isn't it going to take more than increased spending on defence and infrastructure to put Germany and Europe on a more stable footing? And the Draghi report has made it abundantly clear that Europe needs to regain its competitive edge that is lost to China. So what is the structural plan here?
Well, there still is very little, to be honest. I think the coalition or the potential coalition partners now really tried to get rid of the financial tensions, the financial problem, something that brought down the last government. So I think therefore this is a good thing. It also given the outdatedness of German infrastructure, it had been urgent to come up with something to improve German infrastructure. So therefore, this fiscal package is clearly a good thing. And also, given the changed geopolitical situation, spending more on defense is simply a bare necessity in these days. And now it will be up really to the incoming government to also go for tax cuts to bring more incentives for private sector investment, to also make the German economy more innovative. To do that, they would need to invest more in education. They will really need more to increase the participation rate in the labor market, and they will also need to identify other sectors than automotive, so sectors that will be able to actually carry the German economy, the German industry, over the next 5 to 10 years.
Are you concerned, though, that going forward, it's a heck of a lot of money, and it's the kind of spending that Germany is not used to, right? What are the risks? I mean, we've already got Fitch out warning that Germany's coveted AAA rating could be at risk longer term.
Well, I think that is a bit overdone when you look where German debt to GDP ratio is currently. We're slightly above 60% of GDP, clearly far below what France has, what the US has, or also Italy has. So I think if you make some basic assumptions, the infrastructure spending plus the additional defense spending would probably bring the German debt to GDP ratio over the next 10 years from currently 60% of GDP to around 80% of GDP. Is this then really a big concern? No, it's not. I think especially it is not if these investments really go into infrastructure, really make or increase Germany's potential growth rate. So then it is useful investment. So my biggest concern, however, is that we will see that these investments do not go into future-oriented infrastructure, but that we might see some political deals that will channel these investments into other sectors. And that is my biggest concern. So it is going to be key that the next government will really use this money to be very specific and invest in infrastructure and defense and in nothing else.
Carsten, what happens if President Trump acts on his threat of 200% tariffs on European wine and spirits? How destabilising could that be? How destabilising could reciprocal tariffs on April the 2nd, if it comes to that, be for European export growth?
That would definitely hurt the European export industry. And well, I'll give you some numbers. For example, a country like Germany currently exports 150 billion euro to the US every single year. So if we get, the reciprocal tariffs, if we get higher tariffs, clearly the German, but also the European export industry will feel it. So I think that is clearly a given. So the tricky thing right now for all analysts, for market participants, but also for the ECB is, how do you now bring the positive elements of today's German decision into a forecast when at the same time we also have potentially negative elements stemming from the looming tariffs. And that is, I think, the biggest challenge. So I think in the short term, it will clearly be more the negative side that could come from these looming tariffs come April 2nd. In the longer term, I would really expect this German fiscal package plus European defense spending to clearly boost European growth.
Okay.